If you've ever watched a modern skyscraper during a hurricane, you know it doesn't stand perfectly rigid. I mean, if it did, it would just snap under the pressure.
Right, they build those massive tuned mass dampers inside there.
Exactly. Giant internal pendulums that sway against the wind, absorbing all that kinetic energy to keep the entire structure standing. And welcome to the deep dives, by the way. Today, our mission is to figure out how Bitcoin just acted exactly like one of those dampers.
It really did.
Yeah, in an absolutely chaotic 24/7 news cycle, we watched this asset take a massive macro hit, perfectly bounce off the $61,400 support line, and then just march straight back up into the $62,700 range.
It was a masterclass in digesting external force rather than, resisting it. Because the immediate question for anyone watching this market is just, how does an asset absorb escalating geopolitical conflict and a hawkish Federal Reserve without completely collapsing?
Exactly. If you're sitting at home watching your screen while the U.S.-Iran ceasefire collapses and international oil prices instantly spike, I mean, you're probably wondering if you should panic sell. Combine that with Fed Chair Kevin Warsh heavily signaling a higher for longer rate environment, and the pressure is just immense.
Which is exactly why Bitcoin initially dropped. It behaved like a high beta risk asset.
Essentially selling off just like a volatile tech stock would.
Right. When borrowing costs go up and geopolitical fear sets in, people sell. But then the mechanics totally flipped. Buyers aggressively stepped in, utilizing the spot market as a non-sovereign hedge against fiat debasement.
They saw energy shocks coming, assumed inflation would follow, and bought the drop. But here's where it gets really interesting, because the institutional data tells a completely different story than retail spot buying.
Oh, definitely. Wall Street seems to be playing a massive portfolio seesaw right now.
Yeah, U.S. ETFs saw $84.9 million exit Bitcoin products, while almost simultaneously, $70.5 million flowed into Ethereum ETFs. I mean, are institutional managers treating Ethereum as the growth-focused tech play while leaving Gitcoin to absorb the heavy macro shocks?
It is a classic bimodal divergence. Basically, Wall Street is splitting its brain in real time. Portfolio managers are executing these highly calculated pair trades.
Using Bitcoin as the defensive shield.
Yes, the shield against inflation, while treating Ethereum with its smart contracts as the sword for tech growth. They are intentionally rotating capital away from Bitcoin to let it digest this near-term selling pressure from the broader macro environment.
So Wall Street is rotating capital, but the stress isn't just on the trading floor. The people actually running the network, the miners, they are facing their own brutal liquidity crisis right now. The miner cycle stress composite is sitting at historic lows.
It's rough out there.
Wow, yeah, with 20% of the network currently operating at a net loss.
And we really have to look at the mechanisms driving that. Miners are being squeezed from both sides. You have rising energy costs from that oil spike, perfectly colliding with the post-halving reality of reduced block rewards.
And that operational strain heavily dictates market structure, right?
It does. We just saw the collapse of the massive $1.5 billion BSTR SPAC merger simply because institutions refused to back a leveraged single-asset holding company in this high-interest climate.
And while that internal corporate friction is peaking, the external regulatory vice is tightening just as fast. Over in Europe, Bull Bitcoin is suing France over the new DAC8 data surveillance rules.
Yeah, that case is huge.
They are arguing that by forcing exchanges to collect and centralize immense amounts of personal user data, regulators aren't actually stopping crime. They are creating a centralized administrative honeypot.
Which is just a prime target for hackers to steal user identities en masse.
Meanwhile, the U.S. faces a hard August 7 deadline to pass the Clarity Act, or the industry gets left in a jurisdictional vacuum. So, okay, let's unpack this. If miners are capitulating and major mergers are failing while regulations tighten globally, is the ecosystem fundamentally at risk? Or is this just a healthy forest fire clearing out the dead wood? I mean, look at Marathon Digital pivoting their footprint into AI data centers.
Well, if we connect this to the bigger picture, I wouldn't call it a lifeboat, I'd call it an evolution. Well-capitalized firms are using this operational friction to consolidate power and adapt.
So they aren't abandoning the network.
No, they are diversifying their revenue streams so they can survive the cyclical lows of mining. Despite all of this friction, Bitcoin is maintaining steady spot demand. The protocol itself acts as the ultimate shock absorber.
So it's digesting the ETF outflows, the miner capitulation, and the geopolitical spikes without breaking. But it leaves you with a massive question to ponder moving forward. If European regulations like DC-8 end up driving privacy-focused users completely into the shadow economy, right at the exact moment Wall Street heavily financializes the asset on shore, are we witnessing the permanent fracturing of Bitcoin into two completely distinct worlds? Corporate crypto on one side and cypherpunk money on the other.